95% of traders fail, only 5% actually make it. And guess who's in that 5%? The big players, banks, institutions, and hedge funds. So if you want to stop trading against them, you've got to start trading like them. That's where smart money concepts comes in. The blueprint behind how the big players read liquidity, trap retail traders, and move the market like a chess game. And lately, everyone's talking about it. Do you know why? Because it works. Even your barber's talking about it now. Hey bro, have you heard about this smart money thing? Oh yeah man, it's how the banks trade. But here's the truth. Most people throw around the term without actually understanding how it really works. So today, I'm going to show you how to think like the smart money. We'll break down the structure of a trend to make sure we're using these concepts correctly. Then we'll go over some actual live trades to see the strategy in action, and at the very end, we'll go over a secret trick to make this strategy perform to a whole new level. But first, let me explain the concept that lies at the core of everything: liquidity. Now, here's the thing. Unlike you and me, who could just click buy or sell whenever we feel like it, institutions can't do that. Imagine you're managing a hedge fund with $500 million to deploy. You can't just hit the buy button and hope for the best. There simply aren't enough sellers available at the current market price to fill your massive order. So what do these smart money players do? They create the sellers themselves. Picture the scenario. Price is slowly grinding downward, approaching a recent low that looks like obvious support. Every retail trader is watching this thinking, perfect, here comes another bounce off support. So they start buying, and naturally, they place their stop losses right below that support level, underneath the most recent swing low. Because if price breaks below it, the uptrend is probably finished, right? Well, that's exactly what the institutions are counting on. They want those stop losses because stop losses are essentially pending sell orders just waiting to be triggered. And remember, institutions need massive amounts of sellers to fill their enormous buy orders. So here's their brilliant strategy. They start selling a portion of their own positions, not because they're actually bearish on the market, but to artificially push the price down. This creates the illusion that the market is collapsing. Retail traders see this decline and panic, adding even more selling pressure, which drives the price down faster. Then comes the magic moment. Price dips just below that previous low, instantly triggering all those stop losses at once. Boom! Suddenly, there's a flood of liquidity hitting the market. Hundreds of thousands of sell orders become instantly available. That's the liquidity. Now let me walk you through the complete smart money strategy framework. We operate on two different timeframes for maximum precision. On the higher time frame, we analyze market structure to determine the market direction and trade along with the trend. This involves marking breaks of structure and changes in character. We then identify fair value gaps, which serve as our premium entry zones. Next, we zoom into the lower time frame to find the entry trigger, which is typically a liquidity grab. Once we identify it, we execute our position and set our targets. By integrating these three elements, you guarantee alignment with the prevailing trend, entries at optimal supply-demand zones, and additional validation from lower timeframe patterns. Alright, before we get into the juicy part, the actual strategy, we need to go over these few key concepts. Let's start with break of structure, commonly abbreviated as BOS. This occurs when price breaks recent swing points. An upward BOS demonstrates bullish momentum and implies potential continuation higher. Conversely, a downward BOS reflects bearish pressure and suggests potential continuation lower. Now we examine change of character, or CHoCH patterns. A bullish change of character develops when price initially breaks a recent swing low, generating a bearish BOS, then immediately breaks a swing high that preceded that BOS. This creates a regular change of character and may signal a potential upward reversal. Conversely, a bearish change of character emerges when price first breaks a recent swing high, creating a bullish BOS, then quickly breaks the swing low that led to that BOS. This indicates a potential downward reversal. Next, we have the fair value gaps. A fair value gap is simply when price moves up or down extremely quickly, creating a huge candle. For instance, the price here moved up, creating this very big green candle. The price moved up so quickly that it actually didn't give sellers enough time to counteract the movement, creating an imbalance in the market. Markets have a higher tendency to eventually revisit these gaps as price seeks equilibrium. We utilize these gaps as critical zones of interest, anticipating potential reactions when price returns to these areas. Finally, we have liquidity grabs, which are essentially for timing our entries. When price briefly extends above a previous swing high, we recognize this as a bearish liquidity grab, suggesting potential downward movement. Likewise, when price temporarily extends below a previous swing low, we identify this as a bullish liquidity grab, indicating possible upward movement. As we said before, liquidity grabs reveal areas where markets clear stop losses before reversing direction. These patterns provide excellent entry opportunities, particularly when combined with our other concepts. Here's some good news. You don't have to draw everything manually. There's actually an indicator that does all the work for you, automatically marking structure break, liquidity grabs, and fair value gaps right on your chart. Anyway, I'll show you how to do it manually step by step without using any indicator. Let me demonstrate this on a live price chart. First things first, open TradingView. If you don't have it yet, I'll leave a link in my description. From the Indicators tab, type Price Action Toolkit and click on the indicator provided by Flux Charts. When you open the Settings tab, you will see many options to apply to the chart. But for now, let's mark the BOS CHoCH and CHoCH Plus in the Market Structure section. As we said before, the BOS label represents a break of structure, which happens when the price breaks recent highs or lows. Next, we have the change of character. As we said before, this signals a potential reversal. The Price Action Toolkit includes an enhanced feature called CHoCH+. This tool can detect when markets form lower highs before breaking the bullish structure. This appears as CHoCH+, indicating a more robust or validated change of character and delivering better reversal signals. Regarding fair value gaps, activating this feature in the tool's settings displays them automatically on your chart. These represent the imbalances we discussed earlier, created when price moves too rapidly. In the configuration panel, adjusting sensitivity eliminates smaller gaps and highlights only the more substantial ones. For liquidity grabs, applying this feature displays red and green dots on your chart. These indicate bearish and bullish liquidity grabs respectively. The price briefly extends above a previous swing high. The tool identifies this as a bearish liquidity grab, suggesting potential downward movement. Similarly, when price temporarily extends below a previous swing low, it's marked as a bullish liquidity grab, indicating possible upward movement. Reducing the pivot length and wick-to-body ratio increases the tool's sensitivity, identifying more liquidity grabs. This captures smaller extensions and additional price movements that might indicate liquidity extraction. Now let me show you how this trading strategy works on the chart. This approach uses 2 timeframes. I recommend combining 1 hour and 5-minute charts, though you can adapt this to other combinations. Just remember your entry timeframe should be at least 2 times lower than your analysis timeframe. On the higher timeframe, our first step involves determining market direction. We accomplish this by recognizing structural patterns. For example, if the price keeps making higher highs and higher lows, breaking the previous market structure, this shows a clear uptrend, and we are bullish until we get a change of character. The indicator will label this for us. If you are doing it manually, just follow the guide I said at the beginning of the video. After finding the direction, the next step is to mark the fair value gap areas. The indicator will label this for us. If you are doing it manually, you can mark a fair value by simply marking the candle's top wick before the big move, to the candle's lower wick after the big move. On the higher time frame, these gaps are more powerful and can act as strong support or resistance levels. In the configuration panel, increasing sensitivity eliminates smaller gaps and highlights only the larger, more meaningful ones. Once you mark these fair value gaps, wait for the price to pull back into one of them. When the price enters the gap zone, switch to a lower time frame to look for an entry. On the lower time frame, you want evidence of potential reversal. A powerful signal is a bullish liquidity grab. This develops when price drops below a recent low, clears stop orders, then rapidly reverses higher. If this movement also breaks short-term bearish structure on the lower time frame, it provides extra confirmation. Essentially, it creates a change of character. Our tool automatically marks liquidity grabs. Without the tool, you would zoom out to identify where price previously found rejection or support multiple times. Mark that zone, and that's the level price must violate for a liquidity grab to occur. Finally, let's execute the trade. Position your stop loss below the low of the liquidity grab and set your target at the next significant level ahead of price on the higher time frame. For bearish scenarios, begin on the higher time frame by confirming downward momentum with lower lows and lower highs. Then identify fair value gaps as potential supply zones. When price retraces into one of those gaps, switch to the lower time frame and seek a bearish liquidity grab above a recent high. Enter after confirmation. Position your stop loss above the liquidity grab and target the next key level below. Now that you've seen the power of the basic smart money strategy, it's time to reveal the secret trick that transforms this strategy from good to extraordinary. First thing first, you need to add two crucial indicators to your setup. Let's start by adding the volume profile on TradingView. Look at the left sidebar of your chart and you'll see a series of icons. Find the volume profile icon, which looks like horizontal bars, and click to expand the menu. Select Anchored Volume Profile. I am analyzing the trading week of October 6th through 11th, 2025. Let's set the start of the volume profile, a purely volumetric indicator, at the beginning of the week, so on Monday night. This indicator gives us, on the y-axis of the chart, the price zones where the highest volumes were traded, and most importantly, it gives us the maximum point of weekly volumetric trades, the POC, which is the white line on the chart. The POC is often used in advanced volumetric analysis, together with other signals and indicators, to understand whether the price is truly in an upward movement or is facing, or about to face, a different phase. The way we will use it is almost like a support, meaning we will enter long in the strategy only if we are above the POC of the volume profile. Now we need to add the second piece of the puzzle, the CVD, or cumulative volume delta. Click on Indicators again and search for CVD or Cumulative Volume Delta. Select this one. The indicator will appear in a separate panel below your main chart. Click on Settings and in the Inputs tab select here 1 day and also check this one. In the Style tab, use these settings and 0 as level. You see that oscillating line at the bottom with 0 as the reference line? That's our CVD, and it's going to be our game changer. It is an indicator used in trading to analyze the order flow and understand who is dominating the market, buyers or sellers. We notice that within the indicator, calibrated daily, there is the 0 level, which separates the dominance of sellers from that of buyers. As long as we are above it, we execute our trades normally. Now we are above the POC. The Flux Charts indicator gives an entry signal, but the CVD shows a number well below 0 following a strong previous decline. A trade not to take. Here's what makes this so powerful. Without this secret trick, you probably would have taken several losing trades when the smart money setup looked completely valid, but institutional order flow was actually bearish. The CVD and volume profile combination saved you from those false signals and confirmed when the real institutional move was beginning. That's all for this video. As I explained, you can do this strategy without the indicator, but the Flux Charts toolkit saves you a huge amount of time and gives you far greater precision than you could ever achieve manually. And here's the best part. This month, there's an even bigger discount than usual. Check the description to discover the special offer, and I promise you're going to love it.